Welcome to Hedge Interview. This episode is part of the Investor Views series, which features family offices and other institutional investors from around the world. My guest today is Ryan Kalish. He is the founder and CEO of Allocator.com, a data platform that provides comprehensive fund data to institutional investors. Before founding Allocator, Ryan was on the investment team at Stenham Advisors, a $4 billion fund of hedge funds. At Stenham, Ryan completed due diligence on macro and equity funds around the world. He led investments totaling over $300 million, and he developed a range of quantitative risk analytics tools. He was also involved in the launch of the Stenham Healthcare Fund of Funds. Thank you for joining me today, Ryan.
Thanks for having me, Jennifer.
So tell us about your experience and how you came to found Allocator.com.
Sure. So you mentioned my experience at Stenham. That's a while ago already. That's where I started my career in capital allocations, in alternative investments. So when I was studying finance and statistics and things like that, and I actually interned at Stenham, and eventually I ended up working there throughout my third year of university, and then stayed on for a few years thereafter. And then I started Allocator. I ended up resigning around end of 2014. So I spent about 5 years at Stenham, part of that overlapping with starting Allocator. And then this is really what I've been working on for the last few years. So you said, as you said, Stenham's a large part of the business is fund of hedge funds. I was on the investment team, investment committee, traveling, meeting managers, doing due diligence, recommending funds, going through the investment committee process, and then monitoring those funds post-investment. And that whole process is really something that I've tried to, and Allocator, that's the use case of our clients. So we try to be helpful to capital allocators that are going through that process of finding new investments, monitoring them, making investment decisions. And the idea is to use technology and data automation to support them in that process.
So your experience at Stenham absolutely lent itself to the creation of Allocator.com, because you knew what you were looking for as an institution on behalf of an institutional investor. And so your website notes that Allocator.com was born out of experience and frustration. Your goal was to solve an unmet need, and while performing due diligence on the investment team, you found there were gaps that you needed data that you couldn't find. So tell us how you bridged that gap with Allocator.com.
Yeah, so there are two aspects to it. The main aspect is we're helping investors manage the flow of data from all of their investments. So trying to capture as much granularity around whatever managers report around their investments, and then being able to standardize that unstructured data, and then being able to use that for analyses and reporting. The other side of it, which is actually where we started, is more around discovery, finding new managers, screening, peer grouping. And the initial frustration was more around the managers that we tended to invest in. The data on those funds was not really readily available. And so but those funds were happy to share information with some investors, but not the public. And so that's how that was really the initial idea that got us started. But then over time, we started working with a sovereign wealth fund and a family office that helped us build more of the portfolio monitoring side of what we do, which really since 2016 has been our primary focus.
And since the platform's launch in 2013, you've further evolved the Allocator.com service to meet the needs and informational requests of investors. What are some of the advancements that you've added over the past few years?
So over the past few years, a lot. More recently, also, we're working on a bunch of initiatives. I think the biggest thing is around, I'd say the biggest innovation we've got is around the mapping and standardization of data. So being able to use data that's reported by managers that they report in an unstructured way without imposing templates on the funds. And I think that's a big part of what we do. So by now, most hedge funds report to Allocator. They're only reporting to not all of our clients have access to the same data. But a big part of the change that's been happening at Allocator is expanding outside of just hedge funds into other types of private funds, mainly private equity, but also we're being pushed into private debt and venture capital and different areas, which is really driven by what our clients, who are capital allocators, institutional investors, and family offices, what they have in their portfolio and where they're tilting their portfolio towards.
I've definitely picked up on that trend in my conversations with family offices, that they are definitely, their appetite for private debt and private equity is definitely expanding. So you're obviously keeping up with what they need and want. When you say standardizing, just explain what that means, standardizing data, because you said you don't force the funds into a template, but in my mind, I guess I was thinking of, that is what I think of as standardizing is kind of a template. So what does that mean, standardizing data?
We've built a lot of technology around, firstly, PDF scraping and automation of data from funds. But our approach is we'd like to receive as much information as possible. All information has some level of value. And we then provide tools for the investor to help them map this data so that when if they're invested in 50 or 100 or 150 different funds, but all the funds are reporting in slightly different ways, we give them tools where they can look at that same data through different lenses, so that they can compare funds side by side, where they maybe lose a little bit of the granularity, because the funds, these are private funds. They're not typically reporting full position level trades or things like that. But a lot of it is around high level category exposures, maybe top holdings, some operating metrics of underlying companies. But it's generally patchy. So we try and use whatever we can, and the investors have a way to take control of that mapping tree and to decide how they'd like to standardize that data so that it makes sense for them, given the assumptions that they'd like to make, and also how what they have in their portfolio.
Right. And so do you include fund data that is only reflects funds that are invested in by your clients, or do you have funds that maybe an investor is interested in and wants to watch but isn't in their portfolio, or is every single fund in the portfolio of your investors?
I'd say we're predominantly focused on the funds that our clients are invested in, but we do also have tools for research. So funds are welcome to permission their data to all of our clients. So we do have a nice universe of funds that are sharing data and documents more broadly. And we do also partner with other databases, and clients can upload their own data so that they can build that wider universe of funds for peer grouping and filtering, really.
And so in May of this year, Morningstar acquired a non-controlling stake of Allocator.com. That's very exciting, and congratulations on that. That's pretty huge. Tell us about Morningstar's interest in Allocator.com.
I'd say primarily it's an alignment of values. So Morningstar's mission is to empower investor success, which is very much aligned to our own values. Our clients are capital allocators investing in external managers and monitoring those investments, and everything we do is aligned to help them in their workflow and to, we say, champion the pursuit of clarity, opportunity, and efficiency. So there's a really good alignment there. There is also what we offer is complementary also to the data sets that Morningstar has within their organizations, within their organization, both in Morningstar, but also they own a company called PitchBook, which has excellent data on private markets and private funds. So there's also a good synergy there. But it's as you said, it's a non-controlling interest. We're an independent company, but there's a lot of support that we're fortunate to receive from Morningstar and PitchBook.
That must give you some really great sort of distribution exposure to other investors, because Morningstar has been around such a long time. If they come in through that platform, does that enhance your visibility, I guess, to more investors?
I think it certainly helps to have that sort of halo effect of being associated with such a reputable brand or brands. So it's certainly helped open up some doors for sure.
And so, what types of investors use your data?
So it's all investors that invest in third-party funds. And private funds that are not, where the data is not available publicly. So we have private banks, we have insurance companies, we have wealth managers, sovereign wealth, fund of funds, and those are the types of institutions. They all tend to look like internal fund of funds, and maybe they also have some direct holdings as well.
What types of funds does Allocator.com provide data? You mentioned private debt and equity, but give us a scope.
So our coverage is excellent in hedge funds. I'd say that's where we're strongest. That's where we started. But we're asset class agnostic. So if a client can tell us what funds they're interested in, and we'll track the data on that list of funds. Private equity is a big focus for us right now. Private equity and venture capital.
Mm-hmm. And what types of data points are being requested now that weren't so much requested in the past or even a year ago? What data points should fund managers be more prepared to share, would you say?
Look, there's always a pursuit of transparency and information sharing. I think, it's hard to say what managers should be sharing, because I think it depends a lot on their strategy and what they might need to keep close to their chest. But I think the biggest thing is just give investors enough to understand the strategy so that they can anticipate what environment might be adverse for the strategy, and then continue to be a partner through those tougher periods, and then be there through the full life cycle of an investment. So I think provide as much information as possible would be our suggestion to fund managers that are considering what to share. I think, and investors on the private side, on the private market side, I'd say there's more and more interest in underlying company data, not just the fund level flows, the transactions, capital statements, etc.
Well, transparency has definitely become, over the past decade, just more and more and more important. I think it's a really good thing. So it's a direction that fund managers really need to embrace. I think in order to be successful, they just have to be willing to kind of let people look under the hood and share those metrics, because it's just really critical for decision making. They didn't really want to share so much maybe 10 years ago or 15 years ago, and now it's really changed, but I think for the better for investors. So Allocator.com's success is due in large part to your dedication to understanding investors' needs and responding to those data points. I often emphasize to fund managers that the process of making an investment depends on investor relations, which really means sharing information. So in your experience, how does Allocator.com's how does Allocator.com form lasting relationships with investors?
So, I mean, I think we're fortunate in that we have clients that have been with us for quite a while and built relationships. I think it's, it's more difficult now, I think, in the current environment to build those relationships. But I think it's just communication, trying to understand what the needs are of those investors, who their stakeholders are, what the needs of those stakeholders are, what their process is, how the team is composed, and just try and listen as much as possible.
That may seem like I just asked a question with an obvious answer, but I purposely asked you that question because it's what you just said is such an important thing for fund managers to recognize. And they often, I think, stumble in relationship development when it comes to sharing information and realizing the needs of investors versus their own goals. And I think what you just, and I ask for you to say it, not me, but that is a really important aspect of relationship development and establishing trust and getting allocations is all built on communication from my experience and obviously from yours as well.
Yeah, absolutely.
So why should an investor consider the Allocator platform? What does it offer that they can't get from other database or data solutions?
I think that the way to think about Allocator is, first and foremost, we'll automate data management. So a lot of the information that investors have is kind of sitting in different email inboxes, sitting with different analysts. And there might be one person on the team who's the point person that everybody asks when they want some information about a fund or a portfolio or some analytics. I think that for firms that are looking to move towards being data-driven organizations, we can help just provide a very clean data feed that is bespoke to our client, removes manual data entry so that the investment team can focus on meeting with funds, doing due diligence, using judgment to make decisions, spending time on those value additive activities rather than manual data entry and fighting to find different spreadsheets and formulas that aren't working. I think that data layer is the most important, and we can save time, we can improve accuracy, and we can increase the scope of what a team is probably able to track or wants to track, given the resources. But that's the foundation, is the data. And then we can layer on top of that analytics and reporting and insights, which is much easier to do when you have a good foundation of data. And we're constantly releasing new tools and different ways of using the platform. And we love to build things that our clients and prospective clients are looking for. And that's the primary input into our product development roadmap. So, if an institutional investor is tackling a certain problem or thinking about how they can improve their processes, I would certainly welcome any conversations like that where we can brainstorm and think about different ways of doing things. And I mean, ultimately, we see ourselves as hopefully being the innovation partner of choice for these capital allocators, and to build those relationships over time as these organizations move towards being really data-driven.
That's a huge value add. So it kind of answers my next question, which was, what are the fun data hurdles that Allocator.com is known for helping investors overcome? And it sounds from what you just said, that creating efficiencies so that they can have more time is a huge value add. Would you say that there are other hurdles that you overcome, like as far as not just organizing and presenting the data, but also maybe collecting it as well? That probably alleviates them from having to chase after fund managers, I would think.
Yeah, absolutely. We'll do the chasing on behalf of the investor, or usually multiple investors in that fund. And I think the other thing is that it makes sense for an independent organization to fulfill this function in the industry, because rather than each investor having a function within the organization to standardize and scrape data, it makes sense for Allocator to receive all of the data directly from fund managers, and for them to be permissioned out to different investors with different levels of access, so that the data is cleaned and checked once. And the managers are involved in that process. So the managers can also see what we're doing all along the way, and we're very transparent. And that relationship with the manager is also a big part of the value add.
It's very important. This is a really important function that you're serving, because, as you said, it avoids duplication of this effort across. So every institutional investor has to analyze data and organize it and pull it all together. It's so time consuming. So this is a huge value add for those investors. From your vantage point, what types of funds do you see that are outperforming this year, category wise or strategy wise?
I mean, it's a difficult environment when, you know, just a few stocks are doing so well and pushing up the market. So I think it's all relative to that. But, you know, funds that have had exposure to some of those stocks that have done really well. But we've also seen, I think this has been a very good year broadly for a lot of the funds that report to us. We've seen funds on the macro side doing well. We've seen funds with embedded volatility exposure doing well. We've seen a lot of interest in healthcare, healthcare-focused funds. We've actually been doing a webinar series focused on investments in healthcare, which has been very well received. And also just private markets in general. I mean, there's less of a frequency around trading in and out of managers on that side, but it's just more and more interest in those strategies.
And what types of strategies have suffered in the past year? It's been a hard year.
I think it's just been around timing. I think the funds that just got their net exposure wrong, you know, maybe cut their exposure too late and then didn't ramp it up early enough, and then in the last few weeks, I think that's been just trading around the markets. I think that's been a big differentiator between funds that have done really well and funds that have that haven't done so well.
Right. So last month, the Financial Times published an article titled "How Brexit and COVID-19 Combined to Hit UK Hedge Funds." How can UK fund managers prepare to minimize the impact of these events?
Well, I mean, COVID and Brexit, I think, are very different things. I think there's a lot of talent in the UK in the investment industry. I don't think that's going away in a hurry. I don't know if I have a really good answer for you on that. I think COVID is. I think the main challenge around COVID is communication. Just not being able to meet people in person and building those trusted relationships, especially at this difficult time, are really important.
Right. I mean, you can't really. Some of these events, they just historically, if you get sideswiped, you get sideswiped. You can't always know what's coming. But to your point about communication, I guess then, how should fund managers handle crisis management and adapt when things are not going well?
You know, in this day and age, I think a fund should be able to work remotely. And from an operational perspective, I don't think there should be any issues managing a fund, in this environment. And I think there probably are opportunities, if anything, around COVID and Brexit for investment returns. And I think healthcare is a nice example of that. You know, we've seen, driving capital towards healthcare initiatives is something that, we should all be pushing for, and those investors have been rewarded for that. So I think that's funds that maybe have a multi-strategy mandate or multi-sector, I think, driving capital in that direction. And, I think for a long time, biotech and healthcare was an area that a lot of investors just didn't feel well equipped to navigate. I think that's just more and more investors are showing an interest in that space.
Right. Some niches that were less so volatile and less interesting years ago are certainly very interesting now. Do you see any interest in or growing interest in the area of blockchain and cryptocurrency, or is that still too nascent?
We're definitely seeing interest, but I wouldn't say activity. It comes up a lot in conversations that are very, very broad conversations, let's say. And we've spoken to I shouldn't say a few, a handful of fund of funds focused on blockchain and cryptocurrencies. I don't think any of our clients have meaningful exposure to cryptocurrencies or cryptocurrency trading funds. And I think those that do, they just really own Bitcoin.
Right.
As opposed to hedge funds trading around these cryptocurrencies. But I think to your point about volatility, I think that's, around just your previous question about the environment, I think, and your point around volatility, I think that's got to be good for active managers, and that glut of volatility that we saw for years before. I think that's really been released and should be a good environment for active funds.
Right. There's volatility can be a good thing if you have the appetite for the risk. It can certainly be a very opportunistic time right now.
Absolutely.
Yeah, it is. It's an exciting time with a lot of new developments happening in the world. So my last question is, what are you looking forward to next year? This is as we're coming to the close of 2020. What are you looking forward to in the coming year?
I'm just really excited about some of the innovations that we're working on, some of the technology we're building that we'll be releasing in the early part of next year. And it's continual. We release something once a month, usually once every 6 weeks. But every now and then we have these big releases that really change the value add in a big way in different areas. So I think those are the kind of things I'm really excited about. And and also just hopefully being able to travel more and get back on the road and meeting people. I'm hoping that at some point next year that'll become more normalized.
I can't wait for that. It'll be nice to have events that are in person again and people be able to collaborate in person. I'm grateful for Zoom and being able to talk to you today like this, but it'll be nice certainly when travel resumes. That'll be great. But thank you so much for your time today, Ryan. Your insights are very valuable and much appreciated. So thank you. Thank you for your time.
Thanks for having me, Jennifer.